Hello, everybody. Luke Gromen, FFTT. Hope you all had a great long holiday weekend here in the USA for Labor Day. I had a great weekend. First weekend of Fall League baseball for my middle son. So my wife and youngest son went down to watch a couple games, which was pretty cool. So looking forward to seeing more. At any rate, let's jump into the questions. Appreciate everybody's questions as usual. A lot of great ones. I want to get into them. Okay, first, I was asked what indicators do I look at as a quote-unquote shortcut for where things may be headed. Historically, I would say first off, it varies based on context. Historically, I've watched things like heavy-duty truck net orders as a key early cycle indicator of things turning up or down. More increasingly since in recent years, I've been watching the stock market as a leading indicator because watching stocks, where stocks go, tells us where the economy is going to go. Increasingly in the last 5 to 10 years, the stock market effectively has become the U.S. economy by virtue of the marginal consumption connection. I would also say I watch what the Fed's doing vis-a-vis U.S. Treasury issuing. When the Fed buys enough treasuries, then the dollar goes down, risk assets go up, the economy goes up. When the Fed does not buy enough treasuries, given everything else, then the dollar goes up and risk assets and the economy go down. And so for me, it varies by context. Like I said, heavy duty truck net orders. Its stock prices are a leading indicator of the rest of the economy now, and then what the Fed does vis-a-vis buying enough treasuries or not buying enough treasuries. Next question is from VM. Is the EU and UK looking at hyperinflation given the energy crunch, plus all the industrial bailouts and consumer subsidies coming up the pipeline? Hyperinflation is a strong word. Are they going to see extreme currency weakness versus energy in the dollar at the very least? Yeah, in my opinion, they are. And that then creates a very nasty vortex because nobody wants to be the sucker at the card table holding sovereign debt, corporate debt yielding 2% when German PPI is 30%. The gamble the bond markets have been believing is that the 30% PPI is going back to zero. It's not going to go back to zero. And people in the bond market needs to be thinking about, what if PPI in Germany stays at 20 for 5 years, for 3 years, for 2 years? Do you really want to hold debt that's yielding 1.6%? It's a tough scenario. It's great for the dollar. It's not good for a lot else. It's eventually going to be really good for gold too, probably Bitcoin. From NP, hi Luke, has the way the decisions have been made thus far by Western politicians surprised you? Did you expect them to march this close to the cliff? Given the madness, has the relative weightings in different asset classes you're bullish on changed? I am surprised by their decisions, and I'm surprised how close to the cliff of economic suicide they've been willing to march, and I'm not convinced they haven't taken one step off already, to be honest. Last 5 months, we've been writing to clients that those with longer term time horizons should be building cash while holding core positions in gold miners, commodities, especially energy related, industrial equities in the U.S., and then an allocation to Bitcoin as well, which has obviously not been that's not done well. Trading accounts for the last 5 months, most of that time for us, we've wanted to mostly hold cash. So that is ultimately, maybe some energy as well. So that the closer they get to the cliff, the more the only thing you want to own for a time is dollars, maybe a little bit of energy, and then eventually some gold. Let's see here. From JH, might there be strong global capital flows to U.S. equities this fall, even though the USE and the PE is directionally down, even though earnings are down, since other equity markets are in bad shape? In a word, no, in my opinion. You get the dollar up, you get what's going on around the world happening. I think you're going to get a collapse in U.S. equities. Maybe you get less of a collapse in U.S. equities than in other stock markets. But remember, the U.S. equity market is 65% of global equity market cap. All the milkshake already happened. It's past tense. We already sucked up all that capital. It's here. Now they need the capital. What are they going to do? They've got 2/3 of the world's equity market cap is in U.S. equities. They're going to sell U.S. equities to raise dollars, to buy energy, to pay down dollar debt. So is it possible, given the currency differentials, that U.S. equities outperform? Yeah, but unless you're putting on some sort of spread trade where you're short foreign equities and pick the right ones, by the way, and make sure they're as liquid, etc., against U.S. equities, I don't think U.S. equities do well this fall. I think the clouds, even though a lot of metrics are oversold, the clouds are darkening by the day at this moment. So at least until the Fed officially pivots. And critically, all of this will force the Fed to pivot sooner than consensus thinks, in my opinion. But for the near term, storm clouds are getting darker and darker. From Will, very curious about your thoughts on the melt-up thesis. Another 50% up from here to all-time highs, then deep crash in 2023. Macro sure doesn't seem to support it, but every time I think the market should do a thing, it does the opposite. It does tend to do that. I think you need to see the Fed officially be forced into pivoting, into regrowing their balance sheet or moving in that direction. And the leading indicator to that, in my opinion, is U.S. Treasury market dysfunction. When you see days like today where you get some weak data, where you get risk off after last week's risk off, and you get the dollar up and you get treasuries down big. Look at TLT today. It's getting hammered. That's problematic. That cannot be allowed to persist for very long in the Fed's eyes. And so we're not there yet, but we're getting close to where the Fed's going to have to pivot to maintain an orderly market in the Treasury market. Speaking of that, from BR, what does a Treasury market dysfunction look like? It's rising Treasury yields in a softening economy and softening inflation, and critically rising to levels that are politically inexpedient, shall we say, which is to say it hurts the real economy, right? That the 10-year Treasury yield is basically the real policy rate of the real U.S. economy. Mortgages are based off it in particular. You get the 10-year at 4%. You're going to have mortgages 6.5. You're going to get the leading, housing side shrinking or in a recession. It's going to be negative for stocks. It's going to be harder on refinancing. There's ripple effects ultimately that go back to tax receipts for the U.S. government. It's going to push tax receipts for the U.S. government back below true interest expense, and interest expense on the Treasury side will be rising due to the higher interest rates. But also remember, the entitlement pay-goes are still enormous. You'll have receipts back below true interest expense, and I think those are the levels where you start to see rates up in the U.S. in a recession, and that risks, with debt to GDP as high as it is, a debt-death spiral in the U.S., in the EU, in Japan, broadly speaking, bursting global sovereign debt bubble. That the central banks stepping in to grow their balance sheets into still elevated inflation to stop the bursting global sovereign debt bubble is, I think, what you need to have a melt up in stocks as the bond market goes, oh gosh, they're printing money to cap yields. Give me something that is not being debased. Let's see. Andrew, can you elaborate how a Bancor system or the use of gold as a neutral reserve asset will benefit America? Yeah, it allows a real-time adjustment to trade or a real-time marking to market of trade imbalances through currency through the neutral reserve asset. So think of it this way. We run a deficit against China. We, the United States, run a deficit against China. We can just print dollars and send them to China. China, historically, not really that much anymore, but historically reinvested into treasury bonds. Now they buy stocks and other more finite assets around the world with those. So basically, we send dollars, they buy financial assets. So the financial side of the U.S. economy gets supersized. while the productive side of the Chinese economy grows and our productive side, our exports, manufacturing, industrials, can't compete with the Chinese, and so they go away. If you have a neutral settlement asset like a bank or like gold that floats in all rates, the United States would not be allowed to settle those deficits with China with dollars. We would have to sell dollars, buy gold or buy Bancor, send them to China, and China would have the Bancor, which would strengthen the yuan, weaken the dollar against yuan, and that would then make American goods more competitive vis-a-vis China. It would force the Chinese, or give the Chinese, the stronger currency to benefit their consumption, or drive more consumption, more consuming of their own production. It would keep more production here in the U.S. and balance things out. And so that, when you talk about this existing system having gone as far as it has, where we have hollowed out manufacturing and the industrial defense base to such a point that it's a national security threat, which when we started talking about it 5 years ago, 8 years ago, people laughed at us. Nobody's laughing anymore. Pelosi's going to Taiwan. She's not there. She's there ultimately about the U.S. industrial defense supply base and how it's been hollowed out. And it's not just in semiconductors that it's happened. So that's why ultimately this system is good for the U.S., why we need to move in that direction. And that is understood at some levels, but not broadly yet. From Dan, we know the dollar system is going to implode. What are some leading indicators that we're on the final descent, as in once you're in the last 18 months or so? That one's actually pretty straightforward. When the U.S. dollar super spikes, that's why you're there. It's a very ironic, very paradoxical thing. The milkshake super spike is not woohoo, everything is awesome, we're winning. That's the death throes. That's what the death throes of the existing dollar-centric post-71 system looks like. Is the dollar goes vertical, and then gold starts going up, and that's how you'll know. And so let's watch for it. Like I said, ultimately a transition to this. I don't think the U.S. is going to lose dollar reserve status. I do think the Treasury bond is on its way out as primary reserve asset globally. From F, many Americans have large 401k balances and they've logged heavy losses in 2022. Many of these folks do not understand the consequences of a sovereign debt crisis would have on their portfolio. What options would you consider if you were a 401k investor? Here, I think it would depend on the age of the investor in question. I think you need to be cognizant if you have money in the markets that what a global sovereign debt crisis will look like will very likely be a crash in risk assets and then a policy response of sort of super printing followed by a super spike in risk assets, except with more inflation. So it would really look like a lot like what we saw in COVID, except with more inflation right off the bat, in my view. And so if that's correct, then that's why I say it depends so greatly on the age of the investor. If you're close to retirement, you need to be aware of liquidity needs, when you're going to need cash, when you're going to need that money versus your need for growth. Ultimately, as you look out over a 12, 24, and beyond month time horizon, in my view, the greatest challenge is not going to be nominal growth in the portfolio post potential crisis, but keeping up with inflation post global sovereign debt crisis. That I think is going to be a much bigger issue to focus on. But again, I think it will likely be a whoosh down followed by a super spike up with a lot more inflation much quicker than what we saw post COVID. So with that, I'm going to finish up for today. As always, thank you very much for joining me. Really enjoy catching up. If you're interested in learning more about what we're up to, if you like these updates, check out FFTT-LLC.com for more information about both our institutional products as well as our Tree Rings product. 10 most interesting things, brief synopsis about what grabbed us about that point, how it makes sense with how we were looking at the world, or how it refutes how we were looking at the world prior to reading that. So everybody have a great rest of the week. Look forward to catching up soon. Take care, everyone.